What the fuck is EBITDA, and why should you care? Stay tuned to learn why all managers should pay attention to this metric. When I went to business school, I learned a lot of fancy ways of saying buy low, sell high, and EBITDA is a perfect example of this. It is a simple concept baked into a jargon pie. Its primary use, comparing businesses on an apples-to-apples basis. Investors use it to strip away the financial component of a business. The financial model is going to differ from investor to investor and business to business, but the core operation should stay constant, and EBITDA is a measure of that. EBITDA goes by a lot of names. Operating margin, operating income, EBIT, EBITDA, EBITDA. For the purposes of this video, they're all variations on the same thing, so I'm going to stick with EBITDA. So what's the acronym mean? EB stands for earnings before. Earnings before what? Well, interest, taxes, depreciation, and amortization. If you're not familiar with depreciation and amortization, I'll touch on those in a sec. But all of these are financial expenses or accounting treatments independent of how the core business is actually run. That's how we get to EBITDA. So let's take a look at EBITDA. What does that stand for? Well, interest and taxes are pretty self-explanatory. Depreciation and amortization are the same idea, but they're applied to different kinds of assets. Essentially, the large one-time expenses the business has to incur, buying a building, investing in new equipment, building a new product, those need to be spread out over time so that the cost on the income statement reflects the life of the asset. Now, this is a financial fiction. Why? That's a whole nother video. But for now, understand that that needs to be deducted back because it's not an actual expense of the business in any given year. So to bring this to life, let's dissect an income statement at a very summary level. We start at the top with sales. That's the money you get from selling stuff to other people. Then we've got to deduct off of that the operating expenses of running the business. That's stuff like rent, marketing, people, toilet paper, coffee. All of that stuff comes out, and then after that, we take out the financial stuff. Interest, taxes, depreciation, amortization. And when we end up at the bottom, we've got net income. That's the bottom line. Now, that place in the middle between operating expenses and financial expenses is where EBITDA lives. It's called operating income, it's called EBITDA, and all the other things I mentioned earlier. But it's basically the money that's left over after you pay for running the business to pay for the financial stuff. That's EBITDA. So at the end of the day, EBITDA is a narrative about the business, and the story that it tells is what is the core operation generating independent of financial measures. If a company is sold, there's a very high probability that the acquirer's financial model is quite different than the seller's. EBITDA allows both parties to value the business based on the core operation of the business, independent of the two financial models that they're going to have before and after the sale. If the owners of your business have an interest in raising equity or debt for the business, I guarantee you they're paying attention to EBITDA. Why? Because investors and banks and other people use a multiple of EBITDA as one of the key valuation metrics. If an industry is trading at 3x EBITDA, that means a business generating $1 million in EBITDA is worth $3 million. Now they're going to use net income and some other stuff to come up with a composite valuation. But EBITDA is one of the foundational building blocks for generating a valuation on a business. More importantly, it's one of the building blocks that you as an employee or manager in that business can have a pretty direct impact on. So it's important for you to understand what it is and what you can do to improve it. So let's bring this to life with an example. We've got an investor, we'll call them Pentley Capital Partners. They want to invest in the purple widget market, which is trading at 5x EBITDA. Now, we've got one company, Brand X, run really leanly. They've got a very strong EBITDA on $10 million in revenue of $1 million. So at 5x EBITDA, they're worth $5 million. An investor can make a relatively safe investment and generate a 20% return every year based on that without doing much of anything. Now, Brand Z, not run quite so well. Same top line revenue, $10 million, but only $600,000 in EBITDA. they're going to be valued at $3 million. So what's an investor with a penchant for risk going to do in this situation? They're going to buy brand Z for $3 million. They're going to streamline the operation, and 3 years later, they're going to sell it for $5 million. They're going to pocket the $2 million, and they're going to have made some money along the way. And as you can see from this chart, their return is almost twice on an annual basis what the investor in brand X earned. That, my friends, is the world of private equity. And the foundation for that buy low, sell high strategy was EBITDA. Anything you can do to streamline operations and control costs is going to have a positive impact on EBITDA. A strong EBITDA makes it easy to get bank loans and friendly investors in to help grow the business. Well-run places that are growing are fun places to work. Inefficient operations, on the other hand, are blood on the water for shark-like investors. Being on the receiving end of one of these investments is no fun. The operation will be better by the time they're done, but it is really hard on the people going through it. So avoid that. Pay attention to EBITDA. Make sure your operation is running efficiently at all times. So how do you do this? Well, the ways to improve a business are virtually endless. Streamlining purchasing and inventory management, replacing custom parts with standardized parts, the list goes on and on and on and on. That said, every business has a few boulders, big, obvious problems that are getting in the way of efficiency. Now, if you're a senior manager and you don't know where those are, pay attention to the line employees because they're spending most of their time navigating around those boulders. And if you're a line employee, step up and volunteer to help solve that problem. In my experience, the people who do that are the ones who get the promotions. And everyone, learn to look at your business through the eyes of an investor so that you can attract the friendly, low-risk investor and not the unfriendly, shark-like, high-risk investor. Your life will be a lot more fun if you do that. And that, my friends, is what the fuck EBITDA is. Thanks for watching. If you enjoyed, subscribe. And if you've got any questions about EBITDA, OIBDA, boobida, blabada, bubada, put it down below. I'll address it in a future video.